Hello, everyone, and welcome to our advanced discussion of the income statement. The income statement displayed in front of you on your screen does not appear in Chapter 4. I've included it here, though, because I feel like you need a little more advanced income statement to really fully understand what's going on here, and also to be able to use for our integrative purposes towards the end of the term when we merge together knowledge from finance, statistics, economics, and accounting together. Despite that this is a more realistic appearing income statement than what you see in Chapter 4, it is not as complex as the income statements that you would find in the annual 10Ks of companies that you might look up online on their investor relations web pages. Okay, and mainly that's because many of these expense categories are decomposed into many different levels, which just makes the income statement a little longer, a little more involved. All right, so still, this income statement is specific enough to be very helpful. Okay, so let's start at the top. What do we have here? If we start with revenues, and when you hear the phrase top line referred to in business, that always refers to revenues, top line. How is our top line growth? How do we perform on the top line? All that refers to revenues or revenue growth. And so for our purposes here, this company earned revenues of $3,300. That is the sum of both credit and cash sales. So notice that's all sales earned in the year in question, not necessarily all the cash collected. Next up, we have cost of goods sold. Notice what we're doing. We're subtracting those. That's why it says less cost of goods sold, CGS. CGS refers to expenses that are directly tied to production. So things like direct material, direct labor. As our sales orders go up, cost of goods sold goes up too. That's kind of the blessing and the curse with cost of goods sold. Okay, so when we subtract cost of goods sold out from revenues, we get gross profit. And for this company, that's 1980. 1980, a positive 1980. That implies that we're earning a positive gross profit margin per unit sold. More on that coming up. In the description column, notice what I've given you here, a little hint. There is no hope if the company earns gross profit less than zero, right? That would imply that it costs more to make the good than it does than what our selling price is. So that's a real problem, right? Because we're not even close to covering all the other expenses associated with sales, including selling, general administrative expenses. And here that's $594. So this could cover a lot of different things, but for our purposes, let's just think of it as marketing or advertising costs, salaries, various types of overhead. When we subtract $594 in SG&A out of 1980, we're left with EBITDA of $1386. EBITDA is earnings before interest, taxes, depreciation, and amortization. EBITDA is widely tracked by creditors and shareholders because it gives them an idea of, okay, what's this company's ability to meet its loans, its loan payments, and taxes. So a healthy EBITDA is very, very important. It's somewhat a proxy for cash flow. Next up, we subtract out depreciation and amortization. What are these? These are amortized costs. And what I mean by amortized costs is when we buy fixed assets like property, plant, and equipment, we'll assume we're going to pay for them at time zero. So when we get them, we pay cash for them. Now, what the matching principle in accrual accounting says is you have to match the expenses associated with your revenues throughout the future. So if we use the machinery that we purchased 5 years ago to generate sales in this year, that means we got to match some of the depreciable costs, some of that cost basis for that fixed asset to these revenues. Amortization is amortized cost associated with patents, R&D, intangible type assets we've invested in, or if we've acquired another company. All right, we're going to systematically write off its costs over time. So we're going to hold that back against the revenues. So you may say, well, that seems silly, right? Because it's not a true cash outflow. Well, and on a cash basis, that's true. It's not a true cash outflow. So why are we subtracting it out? We're subtracting it out for tax purposes. The IRS allows US-based companies to deduct depreciation amortization. So that's going to lower our taxable basis and lower our taxes. So we like that. If we want to adjust for the fact that depreciation amortization are not true cash outflows, we'll simply add those dollars back. That leaves us with EBIT, earnings before interest and taxes, 990, another widely watched number. Then we subtract out interest expense. This is the sum of interest expense for bond financing, interest expense owed to various types of creditors. That's $100 in this case. Notice that interest expense is taken out before taxes are calculated. That's indicating that all these expenses that occur before taxes are calculated, that they're all tax deductions, tax deductible. Okay. So taxable income in this case is $890. That's profit that is taxable. Then for taxes, for our purposes, for financial planning purposes throughout this course and in future courses, we're simply going to apply a tax rate to taxable income. Now, calculating tax is actually much more complicated than that. That's more of the kind of accounting knowledge that goes in a MAC program. Okay, for our purposes throughout our graduate classes, we will just apply a tax rate of 21%. 21% times taxable income of $890 gives me taxes of $186.90. Once we subtract those out, we're left with net income of $703.10. Big number. That's a bottom line number. Anytime you hear the phrase bottom line, think of, oh, that corresponds to net income. That amount of money, as we know from the last video on the basics of income statement, it's very important because that money, that net income figure, can then be retained on the balance sheet or distributed to shareholders in the form of dividends. In this case, we're going to pay out some of that money in dividends, and we'll assume that our dividend payout ratio is 20% net income. So multiply net income by 20%, that gives us 140.62. And even though we're not adding that money back to the balance sheet, that still has some benefit to us because we're keeping our shareholders happy. It's a good thing because we may want to sell them more stock in the future, right? Yeah. So once we subtract dividends from net income, that gives us our addition to retained earnings of $562.48. That's the same thing as the change in retained earnings or the change in shareholders' equity year over year. A final metric that I'd like to draw your attention to on this basic income statement is earnings per share. And that's $7.03, assuming 100 common shares outstanding. So net income divided by 100. That indicates that each shareholder, the company generated $7.03 in earnings per shareholder. The higher, the better. So now, once you've walked through the income statement, you can really get a feel for, if I want to increase earnings per share, how do I do that? Do I need to seek to lower cost of goods sold? Do I need to lower SG&A? Do I need to lower my interest expense? That kind of thing. Those are the keys to increasing net income and earnings per share. So some key insights from the income statement. At this point, these are probably fairly obvious. Number one, it communicates the degree of profitability. Alternatively, it also shows why shareholder equity changed. Now, the example just given showed positive net income. Not all companies earn positive net income. If net income is negative and there are no dividends paid, that means that retained earnings is going to shrink by that much of the change in, by that much of the negative net income. Both net income and change in shareholder equity are critical to shareholders and creditors alike. The income statement also shows how changes in the various measures of profit indicate how profitability can be improved. That is, which expense categories appear to be problematic. Those are the ones where we may, dig into a little deeper and say, oh, let's try to improve net income by addressing cost of goods sold or SG&A. What can we do without? And anytime we look to cut costs, and that's always a good goal, right? We want to be as efficient as possible, but we have to keep in mind, will we lower our product or service quality if we lower those costs? We don't want to diminish shareholder value by reducing customer expectations or customer experience. One final thing on income statements. If we want to get a better idea of how we perform as a firm year over year, or how we perform as a firm relative to our competitors, we have to do something called common sizing our income statements. A common sized income statement is simply an income statement that scales everything, every account, every line item in that year by revenues in that year. And that gives us, beside our dollar column, a column called percentage of revenues. So revenues at $3,300 divided by $3,300 is, of course, 100%, or 1. Okay. So I'm dividing every value in that current year column by $3,300. This shows us our expenses as a percentage of revenues. So one of the advantages of looking at this is you can express your percentages as, okay, if sales go up by $1, to what degree will cost of goods sold go up? To what degree will SG&A go up? And ultimately, what we can do with this at a much later time is use this approach to apply to a pro forma process where we assume that revenues are going to increase by 10%. We can use these percentages to estimate how, once we forecast our revenues, how estimated cost of goods sold will react to that. Okay. So in this example, cost of goods sold at $1,320 divided by $3,300 is a percentage of 40%, meaning that cost of goods sold in this current year equaled 40% of revenues. Is that good or bad? Well, we'd have to know where the company was at last year. We'd have to know what our competitors do, right? Absolutely. Another way of looking at that 40% is we could say, for each dollar of revenues, the company has 40 cents in cost of goods sold. Gross profit is 60% of revenues. That's what we refer to as the gross profit margin. If you watch Shark Tank much, you know that gross profit margin is discussed a lot on that show. And this is a good point to bring up that connection, because if a company is earning a really high gross profit margin, then we would say that the product or service has a chance to make it. Because if the company can scale up operations and generate a whole lot of additional unit sales, and that's really going to add to the bottom line. The higher the gross profit margin is, there's just more cushion left in gross profit to cover additional costs. SG&A was 18% of revenues, meaning that if revenues go up by $1, 18 cents more in SG&A. EBITDA is 42% of revenues. Depreciation and amortization, interest expense, and taxes, we usually aren't quite as interested in interpreting those as a percentage of revenues. I went ahead and calculated them as a percentage of revenues just to be consistent. But you can make the argument that depreciation, amortization, and interest expense should stay the same year over year, because both of those are going to be more based on what's our company's capital expenditure policy, what's our capital structure policy in terms of our use of debt. Taxes, usually you'll just calculate taxes as a percentage of taxable income. In this case, in this year, it's 6% of revenues. Net income, which is also called net profit margin as a percentage of revenues, very helpful, 21%, meaning that for each dollar of revenues, we would expect to earn an extra 21 cents in net income. And that's very important to shareholders. They want to invest money in companies. They have high gross profit margins, high operating margins, and high net profit margins. Those are hallmarks of healthy companies and established industries.